All right, everybody. So our agenda today is going to be basically off of these 4 points. First, looking at the market in terms of short-term trends, and by that I mean last week and how it compares to a very similar week in the calendar back in 2019. Long-term trends, more looking at a monthly perspective and a year-to-date perspective. Market segmentation, particular areas of the market that I think are of interest to you, so therefore are of interest to me, and I want to make sure that we talk about them. If we do have time, I will jump into InfoSparks and we can kind of play around with some of those tools. And then we want to make sure that there's time for questions at the end. Let's hop right into it. If I can get my mouse to work. There we go. And we're going to give you a little pointer so that way everybody can see what I'm looking at on the screen. 3 overarching trends that I want you to keep in mind throughout all of this, and just these are the main takeaways, folks. Buyer activity is strong. 2020 was record-breaking, as I'm sure all of you know, particularly that later half of the year. And now the big question is, can 2021 surpass that record in terms of buyer activity, buyer demand? So far, it has exceeded the first half of the year, but we're coming into a very busy part of the year in terms of 2020's buyer activity. We'll see that in detail in some of these charts, but it's a question that still remains: is can 2021 surpass the buyer activity from the year prior? Seller activity on the other side, and I'm sure some of you see this yourselves, it is weak. Sellers just didn't come to market in 2020. They wanted to stay at home compared to previous years, and they didn't want to put their home up for sale. This year, we have had some positive signs of recovery, but we do have some work to do to get even back up to where we were in 2019. And we know 2019 wasn't ideal. We'd like to expand upon that ideally. So that's still something. There's essentially, quite literally, room for growth. Inventory is by far the biggest factor that's holding back these sales. Active listings, essentially homes for sale, have declined 80% in the past decade, and everything else has not declined to that amount. In fact, sales price, population, they've increased. That in turn increases buyer demand, and the scales are not balanced. And that's one overarching theme that I want to make sure that we have in our minds as we go through this. So let's look at short-term trends. I like to look at 3 major metrics when we're talking about short-term, as in like weekly trends. Showing activity, people who have expressed interest in buying a home by showing up to open houses, showings. And that is a critical one. What we see here in teal is our most recent year, 2021 data, and then in different shades of gray for 2020 and 2019. Essentially, we can see that first part of the year in spring, we had dramatic increase in showing activity compared to the dip that we definitely saw because of the COVID-19 pandemic. We started to get back into a more normal rhythm of what we see in mid-June, and we did take a classic seasonal dip through Independence holiday. Don't be concerned about that. As you can see, it happened all the previous years as well. We're crawling back out of that holiday dip, and it's going to be interesting to see where along the line the showing activity trend fills in between these 2 gaps. Will it exceed that darker line of 2020, or will it be somewhere in the middle? Looking at the information by price range is also really important, because it's not just people are showing up to houses. It's the question of what kind of houses are they showing up to? What sort of price points are people more interested in? And as you can see, we are going to start looking 2019 data, because I don't think it's necessarily fair to be looking at 2020 data compared to 2021 quite yet. We might later in the year, but right now everything's going to be 2019 to 2021. Similar time of the year, July 14th to July 11th. And as you can see, The teal for 2021 shows that we have a nice distribution hovering somewhere around 250 $300,000. Has the largest largest bar here. It's pretty comparable to where that interest was back in 2019. The major changes here that we see are in terms of our more affordable price ranges. There are fewer people showing up to open houses in the more affordable price points. Some of you might already be thinking, big portion of that is because of inventory. I agree, big portion of it probably is. I would also like to just add in that you're starting to see increases in this more moderate to David likes to say pre-luxury price range, especially in the $500,000 and $600,000 ranges. I mean, these are noticeable increases. So we might also be seeing a difference in change of taste. People preferring to have their dollars stretch a little bit more and spend a little bit more on a home in this new change that we have because of being in a post-COVID era. Another way of looking at this, rather than just looking at thousands of showings, is looking at it in terms of percentages. Like we like to call that market share. For those of you who are unfamiliar with what market share means, I love this little pie example right here. The part that is missing is the share of the pie I have eaten. The rest is the share of the pie I have not yet eaten. It is all mine. Yes, not actually giving this away, but that is what we're talking about. We're talking about shares. We're talking about the percentage of the pie. We're talking about how much out of the whole. Getting back into the world of housing market economics here, we can convert those absolute numbers into shares of the whole and see the same information, just a little bit more easy to understand. $250,000 to $300,000 price range has the largest share in 2021, whereas in 2019, the lowest price range, sub 200,000, had the largest share. Speaking to that trend, as well as inventory, which is another really important metric we'll be looking at later in a few slides. It's great to look at these two different bars next to each other, but it might be more simple to look at the differences between those bars. That's how this chart was created, essentially saying what's the gap from 2019's performance of a particular price point to 2021's performance of a particular price point for this mid-July week. And I think this paints a really clear picture in terms of showing activity interest. For those who are looking at homes above a $250,000 to $300,000 price point, there are people who are more active. And if you have sellers who are selling in this price range, which I assume a lot of you are, this is a good sign. There are people who are interested in looking at these types of homes compared to 2 years ago. Not so much in the affordable price range, like we were saying. And those differences it's pretty stark. Overall, yes, showing activity is down between 1 week and another, but not the same for every particular price point. There's some variety there. New listings and pending sales are the two other really important metrics to be looking at when I'm looking at a weekly perspective of what's going on in the Twin Cities marketplace. New listings, because that's seller activity, that's the supply of our products into the market, and pending sales, because that's demand, that is the consumer and their interest in that particular product. New listings, for aesthetic purposes, whenever you see something purple, it's on the supply side of the conversation, new listings, that sort of thing. If ever you see something that is blue, like the Mar dark blue, that is going to be your pending sales and sometimes closed sales, but generally the buyer interest on that side of the conversation. Same sort of line chart that we saw for showing activity here, but just for supply and new listings. The darker the line is, the more recent that performance is. And then this darkest purple line right here, you can see we had about a mixed bag in terms of supply compared to 2020, which was a little lower, in 2019, and very faintly 2018. Which was definitely higher for the late spring. And as we were getting into early June, we took that seasonal dip like we always do. We're coming back out of it. But boy, wouldn't it be nice to have a consistent run of supply above what we normally see. I'm sure people would love to see that on both sides, buyers and sellers. Moving into the price point breakdown of new listings. As you can see, not only are we 35, almost 36% down overall in supply for that week that we're talking about, but by price point, it tells a very similar story. All of it's negative, as you can see, but the more affordable price points have a lower supply into the marketplace compared to 2019. Something for you to keep in mind. Yes, I am not just ignoring the $1 million plus here. It is obviously a different story than what the other higher price points are talking about. But I want to dig into the luxury market a little bit later. So hold off for a moment before we start really focusing on the million plus categories right now. Pending sales, like I said, the demand side of the equation, it's very clear, particularly in the early spring section. Our darkest 2021 line right here was higher than anything overall for the late spring. As we got out into Memorial Day, we started to get some mixed results. Sometimes it was lower, sometimes it was higher than both 2020 and 2019. We went into our dip of July. We will be coming back out of it in next week. And like I said, the big question is, are we going to be below 2019? Are we going to be somewhere in the middle between 2019 and 2020? Are we going to exceed 2020's demand? Because it is very clear that demand was significantly high throughout the later half of 2020. And I would be very intrigued to see if we could surpass that for the remainder of the year. I wouldn't be surprised if we don't, to be honest. This is pretty impressive, but something to definitely keep in mind as we continue into the third quarter. That change in pending sales, broken down by price, tells, again, a very similar story. The higher price points have higher demand, just like what we were seeing in showing activity. The lower price points have lower demand relative to the 2019 control that we're looking at here, right? Overall, 30% down, but it's really this threshold point of about, I would say, 350,000, 450,000. You're right around that threshold if we could divide this bar up a little bit more. But if you're above 500,000, you're seeing more interest than you would have back in 2019. If you're interested in this information, you want to look at it on a more regular basis, you can always click on the market data section, and that will bring you to these 4 tiles. Click on our weekly market blog. I call it Stats Deck. I basically write about these charts that you just saw every Monday morning. You can see them for yourself, or you can see my little 1 to 2 paragraph analysis of what's going on in the Twin Cities. The market in terms of monthly and year-to-date long-term trends. We can move right on into that. I do want to stop just for a minute and ask if people have, just a short clarifying question. I'm not going to dig into anything super deep. I'll save that for the end. But if someone's like really confused and doesn't understand some of the fundamental terminology, I want to make sure we catch that before we basically, cover it again in a long-term perspective. in this next section. So if you have questions, you have, you struggle to have an understanding of a particular part of this, please feel free to type in the chat and I'll take a look and kind of clarify something if need be. I see nothing in the chat or the Q&A, so we're gonna move right along. If I can get my clicker to work. There we go. So now everything that you're looking at, instead of being from a week by week perspective, it is from June 2021 to June 2019, all of June, okay? This tells, again, a similar story, but it's important to notice those differences. And I think you'll start to see those as we go along here. Supply, because we're looking at the purple color, this is supply. And as you can see, we're not down across the board like what we were seeing in the week. We're actually up in terms of some of our price points, which is good to see, from about $250,000 price range on up, we are marginally ahead of where we were in June of 2019. Yes, we're down overall, but that's okay. This is progress, and we like seeing progress, right? And yes, below that threshold of 250,000, we are seeing significant drops, 50% decrease to, even a high 28% decreases. That's noticeable. And it's something that we definitely need to be aware of when we're talking about marginal buyers who are interested in these lower price points. People who are just able to afford their first home are going to be looking at these sorts of homes, and right now, they aren't there like they were in 2019. We need to, prepare our clients for that. What does June, this June look like compared to June's previous, all the way back to 2003? Luckily, we are up a little bit, but we are not quite, like I said in the previous slide, up to where we were pre-pandemic, our most recent pre-pandemic. And as you can see, as we continue to look back at this, we were pretty consistent, flat in terms of supply of new listings across June. That's a good thing in comparison to the dip that we had, but boy, do we want to see a general and a pretty linear increase in this if we want to make sure that there are more housing opportunities for individuals, our buyers who are interested in those more affordable price points. But overall, this is where we want to get back to, right? Looking back, you can see a classic story that we've said time and time before. It was, the bubble of the mid 2000s and the recession that came afterwards, and the ascent back up to a more stable time that we're looking to return to. Right? You'll see a very similar trend as we continue across most of these perspectives. You'll see that sort of dent, if you will, from the recession. Moving over into pending sales, again, we do see increases in the higher price points and decreases in the lower price points in terms of buyer activity. We are up compared to 2019 as opposed to what we were in supply. Very important to come to an understanding that supply over the 2 years is going down and demand is going up, and is creating somewhat of an imbalance, which we'll dive into in a little bit. But overall, buyer interest in those higher price points, like we've been saying. And looking at buyer activity in June compared to other buyer activities in previous Junes, yes, we're down a little bit from the high of 2020, but we are up compared to that more, I'll say, level, marginally increasing, maybe marginally decreasing, but overall level 5 years that we had. We are noticeably up from that. And of course, we're definitely at a level that is above the ascent that we had in the recession years. Great to see that, of course. And we're hoping to maintain this sort of level as we continue and see if maybe we can get this above 2020 as we get to a full year perspective and not just June. Closed sales as well, because we all know, this month's pending sales are next month's closed sales. And we can see there was a stark increase in closed sales, both compared to 2020 and 2021. So this just shows buyer activity, although down a little bit from 2020, it is by no means a huge falter here. It's essentially saying we're starting to hit a limit on an already extreme demand, right? And that extremity of that demand is definitely shown here in terms of closed sales. Sometimes we like to view this both supply and demand on one chart because it's easy to just look at and get an understanding of some other metrics. So we've done that here for you. Same, purple is supply, blue is demand. And as you can see, yes, down and up, like we've been talking about, but in particular, I think it's really interesting to look at the differences between supply and demand in each of these price categories. When they're down, they're fairly level when they're down, both, lowest points, 150 to 190,000, 190 to 250,000, particularly so. There isn't much of a gap between purple and blue in each of these sections, right? But as you go to the higher price points, that demand really starts to show how strong that demand is compared to the supply that is available there. And as you go up in price point, it's even more stark and more stark. It's something that is a phenomenon that is integral to what's going on here. And we need to make sure that we understand that the difference in supply and demand is not just across, the same across price points. It increases as price points increase. Another way of looking at demand or at the short shelf life of products on the marketplace is cumulative days on market. This is median cumulative days on market, so essentially saying half of the homes are signed purchase agreements off the market in 7 days. That's ridiculously fast. I'm sure many of you are experiencing how fast you go from listing a home to all of a sudden having a buyer. That is a whirlwind of a time, I'm sure. I don't know how sustainable this is. It's definitely something that you're experiencing now. And if you're enjoying it, great. But I don't know if we can really sustain a 7 days median cumulative days on market, but it'll be interesting to see where it goes. Another thing that is just so critical to what we're talking about here is median sales price, right? And we have hit a particular milestone in terms of median sales price in the Twin Cities overall. Yes, it has been increasing, and yes, it has been fairly consistent in that increase, particularly for June median sales price over time. But we've hit the $350,000 price point for a median home in the Twin Cities, a 14.8% increase from 2020. These numbers are just based off of from difference between one bar and another. That's mad, right? I mean, it's great for sellers. It's great for people who have that median home. They're getting more value than they ever have, and at a rate that is higher than it's been since 2013. You haven't seen a bump in median sales price in June like that in about 7-8 years. That's impressive. And speaking of those changes in median sales price, that's something worth acknowledging as well. This is a graph of just that, of year over year change in median sales price, the gaps between those green bars that we just saw. And this is looking all the way back to 2004, month over month. And there's a great story to listen to here in terms of stability in increased median sales price. Yes, you have the recession where we had decreases in median sales price, a small tax credit period, and eventual recovery from the recession. And we had a sense of a boom, 17, 18% increases month over month. That's no small feat. And we tended to level out at, every once in a while, maybe 10% increase month over month, but somewhere around 5% for a good period of time. And then as we dipped into 2020 and the later half of 2020 came about, we started seeing regular 10% increase in median sales price month over month. And now as we're in 2021, we're seeing 15% increase in change in median sales price month over month. That is, it's back to the boom that we had post recession. This is just showing that what's driving that, right? What's driving this increase in price? A limited inventory and a really high demand. And as long as those two stay the same, you're going to continue to see a bump in median sales price month over month. And if this continues year over year. So we're talking about medians. And I know some of you have heard this before, but I promise I'll go quick. This is the difference between a median and an average. And we're going to use Jeff Bezos to mention it, because who doesn't love talking about one of the wealthiest men in the world? Jeff Bezos walks into a bar. We've heard this one before. There are 6 patrons, each with the following incomes in order. Jeff comes on in with his $200 billion income. Which one's the average? Which one's the median? Let's get an understanding of statistics here. The average is 2.86 billion. The median is 65,000. Why? For median, you take the first group and a second group of equal sizes, and the person that is in the middle, or the split between those two groups of lowest group, highest group, is your median. Whereas the average is you add all of these together, you divide by the number of people in the room, 7 in this instance. This is why I like to look at medians rather than averages for the most part, because when you have a Jeff Bezos in the room, or a ridiculously high luxury apartment in your neighborhood, it can drive averages up, whereas a median is not affected by outliers like Jeff. Talking about it in terms of houses, similar thing, in orders of 150,000 to 3.5 million. That average is about $833,000, where the median is, like we were saying, the middle point between two groups here. Definitely important to keep that in mind. I personally think when you're looking at the sales prices, median sales price is a little bit more representative of the group rather than 833,000. Another important perspective for us to be looking at is in terms of price per square foot, because as we know, the size of the home can greatly impact marketability, the price overall. Important for us to try to render that out a little bit and get an understanding of, per square foot, how much does the home cost? And as we can see, it shows a similar story as median sales price, which is consistent, right? Gradually increasing percentage all up until about 2021. And then we had a 16.4 increase. Now a median price per square foot is about $181 per square foot. Wow. Another, as long as we're on the topic of money and understanding these price points and how competitive they are, I think it's important for us to look at the perspective of percent of original list price. And as you can see, there has been a jump in the past year between June of 2021 and June of 2020, where we're now, for the first time in close to 2 decades, above original list price by about 4.2%. And this is not just for the month of June. This has happened in previous months because of demand and how high that demand is in comparison to what's available. I'm sure you guys are seeing this as well. 4% is probably, I'm sure some of you have stories that it's well above 4%, but that's about where we're at right now. And it's it's just good to know that it's out there. Another point we need to take a look at in terms of the other side of supply, in terms of inventory. Back in 2007, 2008, in the bubble, we had 36,000 homes that were available in June. And that has obviously decreased. Once we came out of the recession, we were starting to see, still, tens of thousands, close to 20,000 over a period of 3-4 years. And since then, we've been marginally decreasing. We got to COVID, and we are now no longer marginally, but just decreasing. It's actually good to see only 34% decrease. For the past 12 months of me looking at these, or at least 6 months since I've been working here, this is probably the smallest monthly decrease in inventory that I've seen. Hopefully that's a good sign. I know it's a silver lining on a fairly dark cloud, but it's just the reality of where we're at. Another point, to just a technicality that I want to make sure that people are aware of. This is a snapshot of all listings that are under active status on the last day in June. Last day of June, we look at MLS and we say, how many homes are under active status? But this doesn't show all options available to buyers in a given month. Why? Because of cumulative day on market. When a home sells on June 7th and then is gone by June 14th, it can't be under active status on June 30th to be counted in the inventory. It's a part of our methodology that we just can't capture right now. So were more homes available on the marketplace in the month of June throughout that month? Yes. At the end of that month, similar with all of these are all snapshots at the end of the appropriate month of June for each year. But this is what was left over at the end of June. Still worth knowing the differences in these, because it definitely needs to be increasing for all of our stakes, really. For the economic stability overall, it's really important. And nothing is a better indicator of that than month supply of inventory. The quick and dirty way to understand this is essentially the housing equivalent of how far can I go in my car on its current tank of gas without filling up again? When will I run empty? And month supply of inventory, or absorption rate, essentially asks that question in terms of when will the market run empty on houses if we don't supply any more houses into the inventory and the current demand stays and just buys up all the homes that are available. We are at about 1.2 months supply of inventory, the lowest that we have been in about 16, 17 years. That's, again, another stark difference from where we were at even just coming out of the recession. 4 month supply of inventory, 5 month supply of inventory, which ideally is where we want to return to. And why? I know some of you are probably saying, well, we're having prices being driven up because of low inventory. That's good. Why is Jackson saying we need more inventory? Why is Jackson saying this isn't great for us right now? And I will argue long-term stability is probably your best friend here. When you have a seller's market like we have right now, you have low supply, high demand, a lot of buyers that are interested in a few number of homes. The opposite of that is a buyer's market where you have few buyers and many options for them to pick from in terms of homes. A balanced market is ideally an equal number of homes that are available relative to the number of people who are interested in purchasing those homes. When you have a balanced market, neither side has a market advantage. There is still availability for price growth. And it allows for a level of stability that you're currently not seeing right now. If you look back at a lot of these charts, you'll see some of these lines are going up and down and up and down and up and down, right? That's because there's a lot of variability in the market. People, when they have a really strong seller's market, all of a sudden, a good number of these people might just be not intimidated or be intimidated and not willing to participate as a buyer in the marketplace. That causes participation to drop. And nobody wants participation to drop, right? We'd rather have a steady, equal balance of buyers and sellers, so that way we can continue to have consistent and reasonable price growth, consistent and reasonable demand and supply, so that way everybody wins. Okay, long-term trends and affordability. We are going to dive deeper in this, but I do want to pause one more time. If people have questions about some of the things that I talked about here, rather than, again, not just going on a tangent, but clarifying something, making sure that it's understood well, I'll allow 30 seconds or so of me pausing before we dive into long-term trends and affordability. All right, no chats, no Q&A. So let's dive deeper. And who do we dive deeper with? Because this is David's slide deck, so I need to hold on to some of his wonderful, quirky jokes. We're diving deeper with Scuba Sam and Respirator Rachel, with some important concepts in the market that aren't just your classic supply and demand, but give you an understanding as to what's going on and why, answering some of those really tough why questions, right? The disappearing act of affordable homes. You see it in the news, you probably experience it in your own job. The availability of homes here, defined as under $250,000, is decreasing. Yes, we had a decrease in the affordably priced home market prior to the recession. With the recession, that obviously expanded, that shaded area right here. We hit a peak around mid-2011 and then steadily started to decrease. In red, you have St. Paul's percentage of affordably priced homes. Blue is Minneapolis, gray is the Twin Cities region overall. And for those of you who are fans of St. Paul and the ever-going rivalry of the Twin Cities, yes, you win this one. There's a higher percentage of affordably priced homes in St. Paul compared to Minneapolis. Why is there a difference between Minneapolis and the Twin Cities region overall? Twin Cities has more high price options in more suburban towns. Think your Wyzettas, your Edinas, your Prior Lakes, as well as the availability for new construction. Minneapolis is fairly developed relative to some of those more outlying towns in the Twin Cities. And because they have more room to grow, they have more room to expand on homes that are going to be above $250,000. That share of the $250,000 is going to keep shrinking for those more outlying cities. Historically low rates and rising incomes have partly offset price gains. This is basically saying that a median earner seeking a median price home would spend X percentage that you see here to get a home in the given year that you have. And as you can see, bubble era, you would have a median earner spend about 24.8% to purchase a median price home. And that starkly dropped, and we came back out of it, but we're now hovering around high 18s, low 20s in terms of those low rates. Fairly good to see in terms of previous years. This is an important understanding behind this is understanding some crucial incentive that is at play in terms of affordability, and that is mortgage rates. Mortgage rates are helping to make sure that the same median earner is spending less than they would pre-bubble and even during the bubble to get a median priced home. Another great way to look at that is in terms of the monthly mortgage versus the value of that home, right? In dark black, maybe navy blue here, you have that monthly housing cost. And you can see back in bubble years, we had about 1,600 paying a mortgage for a $230,000 home. And there is a noticeable gap here compared to $1,600, very similar, a monthly mortgage in late 2019, paying for a $300,000 home. Essentially, what the point I'm trying to get across here is that interest rates are allowing the consumer's dollar to stretch further and have a higher priced home that is the same monthly cost as what they were getting for a $230,000 home 14 years ago. That's good. You know, that historically low mortgage rates are in a lot of ways what is contributing to the high demand, allowing our industry to still be hungry and take advantage of what inventory we do have. Another way to look at affordability is in terms of price to income ratio. The basic concept here being take your median family income and how many times would you have to multiply that income to get the value of a median priced home. And here you can see the most recent number, 3.6, I think it's like 3.57. It basically takes a median family 3.5 times their annual income to afford a median price home if they were paying straight with cash, no loans, right? That understanding of income to home price is important when you're looking at not only the affordability of the marketplace overall in your city, but how you compare to other cities across the country, because there are a lot of other factors living either by the coast, temperature and climate, population, a lot of things. But at the end of the day, takes assets and value. It takes assets or income of some sort to pay for and to be able to afford a home. What's the ratio of those? And newly updated for you just a few days ago, we have a perspective of where the Twin Cities lands in terms of price to income ratio. And as you can see, we are not doing too bad, everybody. It's a great way to understand how well we're doing when we're looking at how bad other cities are doing in terms of housing affordability. Yes, there are some that are still beating us, but this is something that I think is pretty important perspective for us to have. I know we're at 2:50, and I did not manage my time well, so I don't think we'll be going on to InfoSparks. But I do have a few more slides. I will respect the fact that we want to have questions and open it up for questions. If we don't have any questions, I'll just continue my slides, but I will stop right here and allow for general questions, anything, not just asking for clarification now, but general questions.
You can also raise your hand too, if you want. That way we can call you out. I don't see anything, Jackson. No questions.
All right. I mean, does everybody, there are 13 of us here. So if people want, I can continue through the rest of this and we can end in 9 minutes. And if you have any questions, feel free to just interrupt me at this point. This is now your time. So I'll just try to speed through the rest of this in the next 9 minutes. There's some, fun and interesting little tidbits for you to glean. And I'll make sure, you get as much information as you can out of this hour. All right, everybody, we'll continue going on. Another important thing that we should probably kind of quell the hype a little bit in terms of increasing price of median sales price. This is a handy little chart for us to have an understanding of the track record of median sales price and the cost of a home in the Twin Cities metro area as it's grown over time. Some people would definitely say, these prices are increasing too much. Is this some sort of bubble that's happening? Excuse me. What's going on? Is this ever going to, self-correct or, God forbid, crash on us? I would argue no. If you look at the long-term trend of median sales price in the Twin Cities, these two handy little curves here will give you what David and I believe is a healthy pathway for the median sales price to stay between. And as you can see, talking about those bubble years yet again, median sales price definitely created quite, literally here in this case, a bubble above that curve that is that, the more sustainable path of price growth. It was clearly corrected through the recession and is now still underneath our lower bound of price growth. Yes, it's not necessarily up to date right now, but we wouldn't be that far above, where we would see ourselves. And so I still think there is room to grow in terms of price. Don't be concerned too much about a bubble in that context. Other people probably are thinking about the bubble in terms of supply that is available. And we have yet another chart for that in understanding that supply in teal here in this instance and demand in closed sales being in black. You can see there was, again, we tried to draw this out for you, a bubble, a gap between closed sales and new listings back in 2005, 2006, 2007. Now, if we were seeing a bubble in terms of supply, there would still be a gap like that, but this is a closing instead of a gap. Not to mention, we've just spent the last 45, 50 minutes talking about how we don't have a lot of inventory here, right? So I don't foresee a bubble. I see this as this is classic market economics of a shortage in supply and a reaction that's naturally occurring because of it. In the context of supply and making sure that we have an understanding of what's happening here in the Twin Cities, I'll quickly show you a urban market share. Again, share, the piece of the pie that is comprised of sales in the Twin Cities. And when I say Twin Cities, I mean the proper two of them, just Minneapolis, St. Paul, which we're defining here in this instance as the urban centers. There was definitely this understanding as we went into COVID-19 and the summer of 2020 with the protests that were happening in terms of criminal justice reform, that people were leaving the Twin Cities or leaving the urban centers. And I argue, in fact, the opposite is true. I've highlighted in red here the period from March of 2020 to current day. And yes, we did absolutely see a dip in mid-spring. But as the summer continued on, we saw rough increases in the share of urban activity. And as we got into late 2020 and early 2021, we saw more noticeable increases in urban market share. To me, and as this little dotted line is showing you, we're trending upwards. We're not trending downwards. People are not fleeing the cities. We're in fact marginally increasing urban market share in the Twin Cities relative to the areas around it. And why is that? Some of you might already be thinking of it, and it's kind of alluded to in this little subtitle screen here. Luxury living. Luxury apartments is one of those things that is almost certainly having a hand in increasing urban market share. But one thing I want to make sure that we are aware of, apart from just the hype in the news media of luxury sales, is Twins baseball. And by Twins baseball, I mean a geeky analogy of understanding why there is so much quote unquote increase in luxury home living. This will be the last thing that I say, and then we'll stop. So, Twins baseball. We're coming out of COVID-19. Stage one, we're not going to let every fan in there because we were concerned about spread of COVID. So we let in a first stage of about 24,000 fans. Second stage, once we realized safety precautions were safe for everybody, we let everybody in. The whole 40,000 fan complex could be filled. That's a 66% increase from 24,000 to 40,000. Now, let's take a smaller group of people, not 40,000 people, but just a smaller group of Twins fans. I know some Twins fans, David's family. David and his wife are 2 Twins fans. But now that they've had twins, there are 4 Twins fans. That is a 100% increase. Now, if you're following along with me, you'll see there is something misleading about that, right? When we double from 2 fans to 4 fans, that's a 100% increase. And a 100% increase is not nearly as noticeable or dramatic as that 66% increase from 24,000 fans to 40,000 fans, right? The difference is percentage terms. And when you're talking about small markets like the $1 million+ luxury market here in the Twin Cities, naturally some of those percentages are going to be high or more variable, either really high highs or really low lows, because it's a small group of homes out of the thousands, if not tens of thousands of homes that are available in a given month. That being said, this is the change in closed sales above 1 million for each June 2021, all the way back to June 2003. Yes, we did see a 92% increase in closed sales in the luxury market above from 2020 to 2021. But that's just essentially saying we sold 165 homes from 86. Those numbers are small, so the changes are big. Still important to know. It's good to know that the luxury market is increasing, that it has essentially doubled. That is good to know. But let's try to mitigate the hype a little bit, and making sure that we have a firm understanding of where we're at relative to the whole understanding of the Twin Cities housing market. It's 3 o'clock. I basically will tell you that this is very useful information for you to know in general. It's important for you to have an understanding of each of these concepts, so that way you can answer some of these questions of, are prices going up and down? How much of my asking price should I expect to receive? What's happening in new construction? And understanding that not only will it benefit your client, it will benefit you and your business. It will help you become more informed in general. You'll be able to do some general forecasting, like I hope you kind of picked up in my presentation today. And really important, you can identify emerging opportunities for growth, which will help you become more successful. I'm going to stop because I have to, and let you know that I'm always available to talk about data and economics, either through email, or you can give me a call at Mar. And happy to chat with you. I had your time for over 1 minute. Thank you so much, and I'll see you again next time.